Welcome to the next chapter. Who can get a mortgage loan? The biggest question most people ask is, will I qualify for a mortgage loan? To answer this, we'll look at your financial situation through the lender's eyes. This section explains how lenders decide whether to loan you money and shows you how to figure out how much money you can afford to borrow. Earlier, we introduced the 4 C's of credit: capital, capacity, credit history, and collateral. Now we'll go over these in more detail. They are the most important things to the lender, and all 4 have to be acceptable before you can continue to the pre-qualification stage, or even begin shopping for a home. Read through the written information on the pages following this video, because it includes more detailed information on each of the 4 C's. Now let's talk about the first C, capital. Capital is basically the amount of cash you have available. The more you have in savings accounts, certificates of deposit, and similar places where you can get the money quickly, the more comfortable the lender is that you can take care of any financial emergencies. Some of this money will also be needed for down payments and closing costs. Lenders will ask you to prove how much money you have available and will ask for copies of bank statements, savings account records, and other documents. Capacity is the second C. This is your ability to earn enough money to make the mortgage payment and still pay all of your other living expenses. Lenders will look at your current income and your income history, how much money you've made in the past, and whether you have worked at the same place for a while. They will also look at how much you owe by reviewing your credit history, which is the third C. Your credit history tells your lender if you've repaid other loans on time and in full. If you have, the lender is more likely to believe you will also repay your mortgage loan. If you haven't, the lender may not feel confident that you will repay the mortgage loan and may decide not to loan you any money. Remember, you can meet with a housing counselor and look at your credit history. The counselor can help you figure out these things you may need to do to fix your credit, such as paying off, collection, or other accounts. You can do this before meeting with your lender. When you do meet with your lender, be honest with them and discuss any problems you may have had in the past and how you have fixed them since then. The fourth C is collateral. This is something of value or security that you agree to let the lender have if you don't make your mortgage loan payments. Your lender will look at many things once you've chosen a home: how big it is, where it is located, the age and the condition. These will be included in the report that the appraiser gives to the lender, and the report will set a dollar amount for how much the home is worth right now. Lenders will compare how much the house is worth to the seller's asking price, which may be higher or lower than the appraiser's estimated value. Now that we've learned more about the 4 C's of credit, review each one in more detail on the following pages. Then we'll use a worksheet to figure out your monthly gross income. You'll need your most recent pay stubs, which you use in Part 1, to calculate your net income. As a reminder, net income is your income after deductions. When lenders look at your capacity, one of the 4 C's, they use your gross income, which is your income before anything is taken out. Click Next to read more about all 4 C's, then complete the worksheet.